In today's episode, we'll break down two important stories. First, we'll talk about the three bodies that can't kill Airtel, and then we'll talk about whether the RBI can bring in the big bucks. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Friday, 17th July. Today's edition is slightly different from the ones we've done before. Our first story today is authored by Rohin Dharmakumar, CEO of the Ken, one of the best independent business journalism publications in India. It's based on their deep dive into the history of Airtel, which was released as part of their long-form podcast series Intermission. If you have the time, we highly recommend watching it in full. They also have a cool companion site for the episode containing charts and visualizations created by Anuj Devnath, the Ken's data visualization journalist. Coming to the first story. So picture Sunil Mittal, the founder of Airtel, surrounded by three very powerful planets orbiting him. Physics has an analogy for this situation called the three-body problem, and you might be aware of it through the hit book franchise of the same name by science fiction author Liu Cixin and the adapted Netflix show. So the three-body problem says that when three bodies are orbiting each other in space, it's virtually impossible to predict their path. Eventually, it starts to become chaotic and they crash into each other. In his book, Liu Cixin described an alien race that lives under three suns, making their world's climate unpredictable and forcing them into brief windows of order punctuated by devastating collapse. Swapping for a different setting, Liu could have just as easily been describing India's telecom sector. For 30 years, Airtel has lived inside exactly the chaos that has fogged the industry and changed it. Now, in our real world, the three bodies are regulation, technology, and competition. Airtel has been hammered by India's regulators by every wave of telecom technology you can think of and by its biggest competitor, Reliance, twice. Yet, it's managed to come back stronger each time. But first, why was the fight even worth it? See, telecom is fundamentally a regulated oligopoly. In any market, anywhere in the world, this sector typically has at most 3 or 4 players. It's essentially a business where the regulatory moat is disguised as a license, and those with that license sell an incredibly addictive and recurring service. Nobody cancels their mobile number. You might cancel your OTT subscription, you might decide not to order from a quick commerce platform, but you're never going to cancel your number. Let's say I got my number from Airtel in 2001. That's 25 years of paying Airtel bills every month, and I could buy a very good car today with what I've spent to keep my one number. Once you build that pipe, you have the optionality to sell many services over it, so the business compounds on itself. Meanwhile, high fixed costs act as a moat against new entrants, and that's paired with nearly zero marginal cost. Airtel's incremental EBITDA on a new 4G customer is north of 80%. In some ways, it's the holy grail of business models, and that's why Airtel was always going to be on the radar of very powerful entities. So, Indian telecom regulation is a shape-shifting reality. One of the truths of Indian regulation of any kind is that everything is always open to subjective interpretation. Who knows the pattern until it's settled in a court, and who knows whether that's true until it's settled at the Supreme Court? Now, to start with, in the mid-1990s, the state awarded licenses in 4 cities based on qualitative points. Airtel almost lost out before lucking into Delhi, and that was entirely subjective, almost as if it were a beauty pageant, which is exactly what industry insiders called this process. And naturally, it was prone to flip-flops.
And the grading and this mechanism of awarding licenses was what was called a beauty contest, right?
But why beauty contest?
A beauty contest because people are given points based on these criteria.
And then, for the expansion of the next 18 cities, auctions were introduced. They were more objective, and for the first time, spectrum was unbundled from licenses and priced separately. But the payment schedules were heavily front-loaded. You were forced to match the highest bid, and roughly 57% of the value was due in the first 3 years, even though building networks took much, much longer. That combination broke companies. By 1999, the whole sector was on the verge of collapse. Every company had defaulted on its license fees. The flaw in the system was bidding fixed license fees because nobody had a clue how much money they would eventually make. Even in the best case, you would have to go nearly bankrupt before you got rich. And then, the same year, the government announced a new telecom policy, NTP, which was a welcome change. It was a recognition of the fact that if every company in the sector went under, there would be nobody left to offer telephony. So the NTP helped make a shift from a fixed license fee to a revenue share model, gave Spectrum an explicit value, and carved out an independent regulator in TRI. For the first time, the industry had a viable business model, and it helped Airtel not only survive the regulatory body, but also keep emerging as the biggest player as it contended with every change. Here's how the intermission episode describes it.
Another person I spoke to, a long-time consultant who's been in the sector for about 25 years, said it was the best policy document even today because it first set out to explain what it wanted to do and then it changed the paradigm from the fixed to revenue share. As a result, by 2002, Bharti is offering mobile telephony in 6 of the 22 circles in India, and it is poised to add 9 more circles.
Now, surviving those challenges means continually building. And building serious networks takes cold, hard, upfront cash, the kind that Airtel, as a first generation company with no oil business to lean on, simply didn't have. It had to learn to grow on money that wasn't in its hand. That's the second body. One of the pivotal moments in the company's history was a lunch between Sunil Mittal and Kurt Hellstrom, the president of global telecom giant Ericsson. So Mittal tells Hellstrom,
I have one request. I don't have the money to pay you.
So Hellstrom asked if Airtel could pay 15% upfront and when the remaining 85% could be settled. So to that, Mittal replied, I'll pay you in happiness. Happiness is when people are making calls on the street and they are happy. So this lunch, which Mittal notably didn't even have enough money to pay for, was meant to be a pitch for a 27 million equipment order. But it turned into a revenue share deal between Airtel and Ericsson. And this was done well before anything was even built. Airtel opted for speed over perfection, and speed won. So the key to this idea of prioritizing speed was Akhil Gupta, who was the vice chairman of Airtel for 3 decades. In his view, perfection was always achievable later, but an advantage lost because of slow implementation can never be recouped. He cracked the idea of outsourcing everything that wasn't core, and it was an unheard of concept for his colleagues. So here's how the episode describes it.
It's almost like, are you trying to sell the family jewels?
In his book, Some Sizes Fit All, Gupta outlines the details of the Ericsson deal. See, usually a telecom equipment vendor wants to sell more boxes while the telco operator needs to buy fewer. Gupta wanted to find a way to flip those incentives and ensure both of them were on the same page. So he deciphered the Erlang, a unit of radio wave capacity, and offered to pay Ericsson per Erlang their customers actually used. That, as per Gupta, was the first time in telecom history where both the equipment vendor and the telco operator were on the same side of the table. Both wanted more consumption. Airtel transferred 1,100 engineers to Ericsson, and the same construct went to IBM for IT. Wildly, an Indian company was reverse outsourcing its network to the West. The next frontier to conquer was the tower network. Now, the cost of having towers exclusive to one player is enormous. It would be more convenient to have the same asset cater to 4 or 5 operators. Each new tenant of a tower would reduce the average rents of all tenants significantly. That's why in 2007, even the bitterest of rivals, Airtel, Vodafone, and Idea, pooled their towers into a new entity called Indus Towers. In Gupta's words, Indus.
So it's a unique model in which a company makes more money when it charges its existing customers less, not more.
So if the Airtel of the 1990s was learning to survive in a dog-eat-dog world, then the Airtel of the 2000s was learning to use scale and money so cleverly that they needed less to grow faster. The technology body moved relentlessly with 2G, 3G, 4G, and 5G, each roughly 10 times faster than the last. With spectrum, you might gain 1 year and lose the next. Yet Airtel thrived in all of this. So in 2002, Airtel launched its IPO. As is true for any other business, that should have been a moment of celebration. Instead, it was a life and death moment because Reliance had the company in its crosshairs by offering free incoming calls and absurdly cheap outgoing calls. Importantly, it installed a fiber network that helped it legally bypass a limited mobility license that technically prevented users in one state from accessing the network of another. They had ensured national coverage now. Airtel stock, meanwhile, fell from rupees 45 to rupees 20, and Sunil Mittal wrote about this point of his life with brutal honesty.
I felt that if we stood up at this time, the storm would just blow us away. Lie low, I said, and we will live to fight another day. I revved up morale in the company by telling all colleagues, everyone expects us to lose, but if we don't, we will make history.
As it turned out, they did not lose. Airtel walked in as a high margin, low volume company and then walked out understanding that India was a high volume, low margin market. Scale is the ultimate advantage in telecom. Around 15 years later, Reliance came back as Jio with everything being free. Voice was free forever. It was just data on an all 4G network. Meanwhile, 65 to 75% of every incumbent's revenue was voice, and industry experts didn't give Airtel a very high chance of surviving this onslaught. But Airtel prepared for Jio like it was a war. They wouldn't let a single premium customer go. The focus of Gopal Vittal, now the CEO of Airtel, was maniacal. And if you slipped a new SIM into your phone, Airtel would obsessively figure out why and would offer you a deal to come back. And then Airtel made a move that went against the grain of scale in telecom. It shed its own customers. Airtel went from having 333 million subscribers to 284 million, shedding 49 million. They were willing to lose what was equivalent to a small country's population because those low value users clogged the 2G network that could be refarmed for 4G. And as they say, what goes around comes around. Airtel started as a premium player, was forced by Reliance to go mass, and then went back to premium when Jio emerged, but this time of its own choosing. Everyone thought Mittal would roll over like Vodafone, but if Jio were honest, they'd admit he shattered their dream. So here's how Rohin says it in the episode.
When this sector started collapsing, it was like taking candy from a kid. Bharti Airtel just did it best. This was both on the consumer side as well as on the enterprise side, because as other telcos were also like struggling and trying to figure out, including Vodafone Idea, I think Bharti just came in and said, look, we are much better. Look at our services.
Sunil Mittal spent his whole career selling visions to partners far larger than himself and getting them to bet on him even if Airtel's presence was tiny. Now he is free to make bets with a multi-decade horizon, even riding the AI and hyperscaler wave. He has consistently been irreplaceable, but he's now building a plan to make himself irrelevant to the future of Airtel. Coming to the second story. A few weeks ago, the RBI effectively gave local banks the green light to offer NRIs up to 7% interest when they deposited dollars. Those same deposits paid around 3 to 4% until then. For that rate to practically double, that to on a dollar-denominated asset is an abrupt change. So when the banking system suddenly starts paying a steep premium to get its hands on foreign currency, it's a sign something is wrong. And that should come as no surprise. In the first half of 2026, India faced a severe shortage of dollars while the rupee kept getting hammered in forex markets. Now, there were many reasons for this, some of which we ourselves aren't sure about. But one facet of the problem, at least, was that India imports roughly 85% of its crude oil, and when war broke out in the Persian Gulf, the price of those imports skyrocketed. As recently as January, the average barrel of crude oil cost India somewhere between $62 to $64. And with the war, that price shot up to nearly twice as much, to an average of $114 by April. And the consequences were terrible. In May alone, for instance, our oil and gas import bill surged by 75% year on year to $17.5 billion, even though the number of barrels we imported barely changed. Meanwhile, foreign portfolio investors, or FPIs, which are overseas funds that invest in Indian securities, were fleeing Indian markets. Now, the war didn't start this outflow by far, but the moment coincided with a trough in the foreign ownership of Indian equities to a 14-year low of 14.7%. But not every pipe was leaking. Net foreign direct investment, which is large, long-term stakes foreign entities take in India, actually improved to $6.6 billion in FY26 from an abysmal $1.6 billion the year before. Trade too held up better than feared, and even while our imports were becoming more expensive, strong services exports and record remittances from Indians living overseas made our current account look brighter. In fact, we posted a current account surplus in the March quarter. For all the fear and despair, our current account deficit for FY26 was just approximately 0.6% of GDP, an entirely manageable level. But in all, money was leaving the country. India saw a net outflow of about $30.8 billion in FY26, which was more than 6 times the $5 billion outflow of FY25. And that trend continued into the new financial year. It was a crisis. With demand for the rupee falling well short of supply, the rupee dropped to a record low of almost rupees 97 against the dollar by mid-May. So the RBI intervened, selling over $60 billion of its foreign reserves since the war broke out to prop up demand for the rupee. But it couldn't burn through these emergency savings forever. The RBI needed to attract a massive, stable supply of new dollars. So there was one page in its playbook that it had used in a far worse crisis back in 2013. And that's what it went for. So in 2013, the US Federal Reserve hinted that it might taper down its bond buying program, which had been pumping easy money into the global economy ever since the global financial crisis. And this triggered a global panic called the taper tantrum. Investors aggressively pulled their money out of emerging markets and the rupee was crushed. To survive that moment, the RBI turned to the Indian diaspora. They offered them a special window to deposit their dollars here at home through foreign currency non-resident or FCNR deposits. It brought $26 billion into the country, stemming the tide. And the RBI is using that tool again. So an FCNR deposit allows eligible NRIs to place their savings like US dollars directly into a fixed deposit with an Indian bank. The money stays denominated entirely in dollars. When the deposit matures 3 to 5 years later, the bank returns the principal and the interest all in dollars. And this can be a great deal for a depositor. They're paid interest, but more importantly, they take zero currency risk. Even if the rupee keeps falling through those years, their repayments are still calculated in dollars, leaving them unaffected. Now, this possibility has been around for a while. But historically, Indian banks would pay just 3 to 4% interest on them, barely beating inflation in the US. Now, this was understandable. After all, those banks were taking a mountain of risk. So when an NRI deposits $100 with a bank in Mumbai, the bank doesn't simply lock a physical $100 bill in a vault. That money feeds into its business. And since its business is in India, those dollars are sold in the open market in exchange for rupees, which are then loaned out. But there's a problem. The bank now holds rupees, but eventually it still has to pay the NRI back in dollars. If the rupee falls, that burden blows up. Say the exchange rate today is 90 rupees to the dollar. The bank takes that $100, converts it, and gets 9,000 rupees to lend out. And 3 years later, the deposit matures. If the rupee has weakened to 100 rupees, the bank suddenly needs 10,000 rupees to repay the principal of $100. And on top of interest, it also has to put aside an extra 1,000 rupees. That's a huge risk. So on day one, the bank purchases a forward contract or a currency swap. Effectively, it locks an exchange rate for 3 years later so that there are no surprises when it has to pay the NRI back. Only this insurance is highly expensive, historically costing banks roughly 3% to 3.5% every single year. Now, if the bank earns 8% on a rupee loan and has to subtract 3.5% to pay for this hedge, there's very little money left over to pay the NRI and cover the bank's own costs. So all it could offer NRIs at the end of this all was a dull 3 to 4%. So on June 8, 2026, with a package of 3 regulatory changes, the RBI re-engineered that risk calculus. First, the RBI removed the bank's hedging burden by taking the currency risk onto its own balance sheet. Under this special window, banks sell the dollars to the RBI at the current spot exchange rate, and when the deposit matures, the RBI will return the dollars at the same rate. So if a bank gives the RBI $100 today at an exchange rate of 90 rupees, it receives 9,000 rupees. But 3 years later, RBI will give back those $100 for the same 9,000 rupees, even if the rupee has dropped. The bank simply bypasses the hedging cost, but the swap only covers the principal, so banks must still manage the foreign currency required to pay the interest. But even so, it kills the risk the bank takes on the principal. Second, the RBI attempted these fresh FCNR deposits from both the cash reserve ratio or CRR and the statutory liquidity ratio or SLR. So, ordinarily, banks must keep a portion of every deposit locked up as idle cash or CRR or parked in safe, low yield government securities or SLR. They couldn't lend out 100% of its deposits, and the effective return on that money was stunted. But by waiving both requirements for this window, the RBI allowed banks to lend nearly every single dollar they raised as high yielding commercial loans, boosting their earning potential. Third, the RBI removed the ceiling that capped the maximum interest rate banks were legally permitted to offer on FCNR accounts. So the interest they could offer now could be decided by the fee market. Each bank could determine its own rate based on how urgently it needs funding and what yields it can generate, hence the wide 5.5% to 7.1% range visible today. With these moves, the RBI effectively allowed banks to fish for high quality capital without risk, all of which could generate returns. But there's another ingredient. While a 7% interest rate is great, that alone doesn't bring in tens of billions of dollars. The real engine is leverage. So the RBI explicitly permitted Indian banks and their overseas branches to lend money directly to non-residents against these FCNR deposits. Since these loans are backed by the deposits itself as collateral in their hands, lenders were happy to provide massive leverage. So consider this. An NRI invests $1 million of their own savings. The overseas branch of an Indian bank steps in to lend that NRI an additional $9 million in dollars. The NRI places the combined $10 million into an FCNR deposit. Now, this is incredibly lucrative for investors. At a standard 6% rate, the full $10 million deposit would generate approximately $600,000 in returns. Of that, let's say the NRI pays 5.5% interest on the $9 million loan, or approximately $495,000. That leaves $105,000 for the NRI, and their net return climbs up to 10.5% on their actual $1 million investment. Meanwhile, India registers a fresh $10 million inflow, even though the NRI only brought in $1 million of original wealth. The remaining $9 million was generated from within the banking system, and these would eventually have to be serviced and repaid, but for now, it stems the tide. This is just one of the weapons the government has deployed. It also scrapped withholding and capital gains taxes for eligible foreign portfolio investors buying Indian government bonds and opened a pipeline for foreign capital through Gift City. So, how much money is actually coming in? According to recent updates, more than $9 billion has been mobilized under this special FCNR drive. That's substantial, but it remains below analyst forecasts of $30 billion to $55 billion. Now, the mechanics of the leverage trade, to be fair, suggest that this would take time. For an NRI to borrow $9 million to deposit $10 million requires complex legal documentation, intense credit approvals, tax compliance reviews, and offshore funding lines. Such deals take weeks to assemble. And because the special window remains open until September 30th, 2026, both banks and wealthy investors have a natural incentive to negotiate rates till then and finalize their allocations closer to the deadline. There's one thing worth noting. The RBI has essentially assumed the risk for how the rupee moves over the next few years. So this is practically a subsidy meant to draw dollars in over the short term. It could suppress near-term currency volatility, but is it justified? As Samir Arora from Helios argues, the subsidy essentially pays for itself. If India can attract $40 billion to $50 billion through the scheme, that massive inflow will naturally strengthen the rupee. And this will make it much easier for us to handle the national oil bill. To him, the money India will save on cheaper oil imports will outweigh whatever cost the RBI incurs by subsidizing the hedge. But that's not the only view. To former SEBI official Anant Narayan, for instance, this can too easily descend into an economic game of whack-a-mole. So the scheme props up the rupee today, but these dollars are not being earned organically by the Indian economy. They'll go back out in 3 to 5 years. In a best case, it buys us time. If we can plug the gaps in our economy over that period, it'll make us more resilient when that outflow happens. But if we can't, this would ultimately have bought us little. We would simply have kicked a financial deadline down the road. Now coming to the tidbits. The Indian government has approved a massive rupees 1.9 lakh crore investment scheme, including Mobile PLI 2.0 and Semicon 2.0. This initiative aims to boost local design capabilities and achieve self-reliance in semiconductor and mobile phone manufacturing. Coming to the next tidbit. Smartphone brand OnePlus is reportedly ceasing its operations in the US and Europe due to financial challenges and a lack of market momentum. This move is part of a larger restructuring effort by its parent company Oppo. Coming to the next tidbit. The Tata Group is planning to enter the shipbuilding industry with a massive rupees 10,000 crore project in Kerala. This major investment is expected to significantly boost India's maritime manufacturing and commercial vessel production capabilities. Coming to the next tidbit. Tata Motors has asked the government to change the newly proposed Corporate Average Fuel Economy or CAFE rules regarding carbon credits. The automaker argues that the current draft would actually make it cheaper for companies to pay penalties rather than invest in cleaner green technology. Coming to the final tidbit. Make My Trip is reportedly preparing to file draft papers for an Indian initial public offering or IPO using SEBI's confidential pre-filing route. The issue is expected to exceed $1 billion. That's all the news I have for you. Thank you so much for watching and see you in the next one. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.